All eyes this week will be on US consumer price inflation data to see whether the market's expectations of more than 4 extra Fed cuts can be justified. And the Bank of Japan holds, albeit with a surprise split vote. That's coming up in our 5 Things in 5 Minutes on Monday, September the 22nd. And then in our deep dive interview, ANZ senior rate strategist Jack Chambers looks at why the US housing market isn't getting as much stimulus from Fed rate cuts as you'd think.
That's partly because mortgage rates haven't fallen nearly as much as you would think, given the Fed easing cycle, because 30-year mortgage rates haven't fallen as much as Fed funds has.
But first, in 5 and 5 with ANZ, this week's news flow for markets is dominated by US personal consumption expenditure inflation data on Thursday night and what it means for the Fed's rate-cutting cycle restarted last week. Here's ANZ senior rate strategist Jack Chambers on what to look for.
What we've seen in the last few months is essentially a stabilisation in the disinflationary trend, where the annual rate of inflation is stabilised at a level which is above the Fed's target of 2%. That matters because we saw last week with the Fed decision and really with Fed Chair Powell's post-meeting press conference that they weren't as dovish in their commentary as maybe the market had expected. We've seen yields have moved higher since the Fed decision, partly because he talked about the risks, the downside risks for the labour market, but he also talked about the risks around inflation, inflation being entrenched above the Fed's 2% target. Those risks haven't dissipated.
In global markets on Friday night, the S&P 500 closed up 0.5% and the Nasdaq closed up 0.7%, both new record highs. But bond prices fell and the yield on the 10-year US Treasury rose 3.5 basis points to 4.139%. Remember, prices move in the opposite direction to bond yields. Gold rose 0.75% to $3,705 US an ounce. West Texas oil futures were down 1.4% at $62.68 US a barrel. The US dollar index up 0.3% with those slightly higher bond yields, with the Aussie dollar down 0.3% at 65.94 US cents. And the Kiwi down 0.4% at 58.58 US cents. Number 2. Jack says there's a risk a hot US inflation number causes a big reaction on markets because markets expect more than the 4 extra cuts ANZ research is forecasting.
So if we get an upside surprise on inflation, like if there were super core measures that kind of strip out the more volatile pieces, if that bounces higher, there might be a bit of nervousness there that some of those tariff impacts are still flowing through to prices, may make the Fed a bit more reluctant to cut. And yeah, we generally have a view that global bond curves, particularly the US curve, will steepen. Essentially that long end rates are going to remain pinned at higher yields.
Number 3. In New Zealand, last week's surprise 0.9% contraction of GDP in the June quarter has really thrown the cat amongst the pigeons for forecasts of what the Reserve Bank will do next. A 25 basis point cut had been locked in before those figures. ANZ New Zealand chief economist Sharon Zollner says there are now 2 clear options.
So the imminent question is, will they cut 25 or 50 basis points when they next meet on the 8th of October, which is actually only, it's less than 3 weeks away, and there's not a huge amount of data out between now and then. So we think it's clear as mud. Some economists have changed their call. Some have not. The market is on the fence, pricing about 40% chance of a 50 basis point cut. That seems pretty fair to us, actually. So we decided it would be useful to just put out a note laying out the cases for a 25-point cut, the arguments for a 50-point cut, and then everyone can use it to test their thinking, no matter what it is, whichever way they're leaning.
Number 4. Sharon says a 25 basis point cut would allow the Reserve Bank to signal more, but retain the option of not cutting too much if things change.
That still gives them the flexibility to change their minds if the data does surprise us by bouncing out of this surprisingly deep hole more quickly. On the other hand, if it really is the case that the economy needs a lot more stimulus, then that's costly, maybe only 6 weeks, but still, there's that trade-off between speed and certainty is always there when you're setting the OCR.
Number 5. The Bank of Japan held its key interest rate on Friday, as expected, but there was one surprise, says ANZ FX strategist Felix Ryan.
What was interesting is we did see a split in the votes. So 7 board members voted for no change, while 2, Takata and Tumura, voted for a 25 basis point hike. Certainly those 2 have been the more hawkish members of the board, as we've been seeing by some of their speeches the last few months. We also did see the announcement by the Bank of Japan to sell ETF and J-REIT holdings as well. That selling does maybe suggest that the Bank of Japan is confident in the market resilience at the moment as stocks rally, and also as we've seen relatively okay economic data as well in Japan.
Felix Ryan there. Now, in our deep dive interview, ANZ senior rate strategist Jack Chambers looks at why the US housing market isn't getting as much stimulus from Fed rate cuts as you'd think.
This week's data will probably inform how dovish the Fed feels comfortable with contextualising cuts going forward. We also get the final Michigan consumer confidence and inflation expectations data later this week as well. What we've seen so far this year is that inflation expectations for the next year, so the short-term inflation expectations, have bounced a bit higher after they trended lower last year as actual inflation fell. So there's been a bit of a tariff impact there. Nowhere near as high as what we saw when we actually had relatively high or higher inflation a couple of years ago, but still there has been a bit of a bounce there. I think that's somewhere where the Fed will be keeping a close eye. They'd want to see that those short-term, but particularly the long-term inflation expectations don't show signs of bouncing higher, because that's when they get concerned about longer-term entrenchment of inflation.
And if there is an upside surprise, as they say, I mean, how vulnerable are markets, the bond markets and the stock market because they're at least the stocks are at record highs. And, it's pretty amazing to see that 10-year down there briefly under 4% for a wee while.
Exactly. I think in both cases, we could see a reaction, particularly in the rates market and the bond market, because we have simultaneously relatively dovish expectations for the Fed. Market pricing for what the Fed will do going forward is actually pricing in a bit more than we expect, more easing than we expect. So if we get an upside surprise on inflation, like if there were super core measures that kind of strip out the more volatile pieces, if that bounces higher, there might be a bit of nervousness there that some of those tariff impacts are still flowing through to prices, which may make the Fed a bit more reluctant to cut. And we generally have a view that global bond curves, particularly the US curve, will steepen. Essentially, that long end rates are going to remain pinned at higher yields, or remain pinned at higher levels, just because it's the combination of the Fed easing has a much more direct impact on front end yields, 2-year yields and under, whereas the long end of the curve, it's a mixture of what the market expects of the Fed, but also a lot of other things shape that, what we'd call the term premium, all the other compensation that investors require to hold a long-term asset. It kind of filtered into the 10-year yield. That includes a bit of policy uncertainty, inflation uncertainty. If the market ever becomes concerned about Fed independence, that will translate to higher than otherwise long-end rates. So we've seen a steepening in the curve, and the risk is, I think, regardless of what happens with this week's data, we're going to trend towards steeper curves going forward, given all those factors I mentioned before.
Does that reduce the Fed's traction in the US economy, given so much of the household and new housing spending is based on that 30-year rate?
Yeah, that's exactly the case, because essentially what happens is the biggest driver of a 30-year fixed-rate mortgage in the US is the 10-year bond yield. So if that doesn't fall as much, if it's stuck around that 4% level, that means it's hard for 30-year mortgage rates to come down. We also get some housing market data in the US this week. And what we've seen in the housing market in the US in recent years, particularly over the last 12 months or so, is a bit of a stagnation, less velocity, less turnover, fewer people moving, upgrading. That's partly because mortgage rates haven't fallen nearly as much as you would think, or usually would be the case, given the Fed easing cycle, because 30-year mortgage rates haven't fallen as much as Fed funds has. So that has a real economic impact. Whether it translates to investment decisions and things like that is a slightly different question. There's a few things happening in the US where we've seen manufacturing investment activity has started to roll over. During the Biden administration, we had things like the Inflation Reduction Act and the CHIPS Act, which supported manufacturing investment, essentially increasing the manufacturing base to some degree through government subsidies and grants. Some of those things, those programs are now rolling off. Offsetting that to some degree is the data center build out. That is sort of almost an interest rate agnostic CapEx pipeline that's occurring. Very heavily concentrated amongst a couple of large tech companies that are building out their sort of AI capacity, but that is having a macro impact, just given the sheer scale of it. So in some ways, the AI boom, or maybe the data center boom, which is also requires more things like electricity generation and water use. As that happens, that's maybe in some ways shielding the US economy from higher than otherwise interest rates for now.
Jack Chambers there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, September the 22nd. Catch you tomorrow with a look ahead to monthly inflation data for Australia due on Wednesday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.